Qatar just declared force majeure on its liquefied natural gas contracts, not for a few weeks, for up to 5 years. That is 12.8 million tons of LNG capacity per year gone. $20 billion in annual revenue wiped off the map. And here is the part that almost nobody is talking about. The Strait of Hormuz is not the only problem. The Persian Gulf itself is too shallow for the supertankers that carry the world's crude. The only deep-water shipping channel runs right along the Iranian coastline. Picture that for a second. Even if every gun went silent tomorrow, you cannot sail a very large crude carrier through a war zone. The oil supply shortage in 2026 is not a theory. It is unfolding right now in water too shallow and too dangerous for the ships that feed the global economy. For years, the consensus story was simple. The world had too much oil. Prices would stay low. Energy was yesterday's trade. But the field-level data told a completely different story. Shale wells in the Permian Basin decline at 35% per year. That means a well producing 1,000 barrels today will pump only 650 barrels next year. Across 15,000 conventional oil fields worldwide, production falls 5.6% annually just from natural depletion. Think of it like a bathtub with the drain open. You have to keep pouring water in faster and faster just to keep the level the same. And for decades, the global supply chain ran on a system called just-in-time. No buffer, no warehouse full of spare parts. Every barrel, every component arriving exactly when needed. Great for profit margins, catastrophic when the flow gets cut. Now companies and governments are scrambling to shift to just-in-case, stockpiling what they can. That shift alone permanently raises demand for commodities across the board. The oil supply shortage in 2026 did not start with a war, it started with geology. Here is where it gets uncomfortable. The S&P 500 energy sector, as a share of the total index, sits at the same relative low it hit at the peak of the dot-com bubble in the year 2000. If you use Exxon as a long-run proxy, energy stocks relative to the broader market are as cheap as they have been at any point in 50 years. Meanwhile, the Nasdaq is packed with companies valued almost entirely on hope. OpenAI has never turned a profit, not once. The Bloomberg World Commodity Producer Index compared to the Nasdaq shows one of the widest gaps in modern market history. On one side, companies that pull real resources out of the ground. On the other, companies that might make money someday. For 40 years, markets have been repricing hope upward and hard assets downward. Now physical reality is forcing a reversal. Both the asymmetric strategy and dividend strategy portfolios, tracked by capitalist exploits, have significantly outperformed the S&P 500 over the past 12 months. And the gap is widening. This is not a blip. This looks like the early stage of a structural rotation in how to invest in energy stocks in 2026 and beyond. So what does this mean if you are a long-term investor trying to figure out where to put your money? Let me put it plainly. For decades, the winning trade was buying growth stocks and ignoring commodities. That trade is reversing. Energy companies are generating real cash flow. Many are paying dividends that dwarf what you get from a savings account. And the supply problems we just walked through are not going away in a quarter or two. Production restarts in the Gulf require more than a ceasefire. They require physical infrastructure repair, well assessment, and resume tanker routes. 12 months minimum, and that is the optimistic scenario. The shift from just-in-time to just-in-case supply chains means higher baseline demand for oil, gas, copper, steel. If you are sitting in cash or in a portfolio heavy on growth stocks, you are exposed to stagflation. That is rising prices combined with slowing growth. Your purchasing power erodes from one side while your portfolio stalls from the other. From the gas station sign at the corner to the energy bill on your kitchen table, this repricing is already showing up in daily life. Commodity investing is not a niche strategy anymore. It is becoming the center of gravity. There are two scenarios to think about. In the first, hostilities wind down faster than expected. A ceasefire holds. tanker routes slowly reopen over 12 to 18 months. Oil prices stabilize but remain elevated because the structural decline in production has not changed. Energy stocks still outperform, just at a slower pace. In the second scenario, the conflict drags on. Russia benefits from the West, fighting on multiple fronts. Iran treats this as existential. China watches and waits. The Gulf stays disrupted for years. LNG stays offline. Stagflation deepens. Commodity producers become the most important companies on the planet. In either case, the direction is the same. The magnitude is different. The energy sector relative to the S&P 500 has room to run that we have not seen since the early 2000s. The risk is not in owning energy. The risk is in pretending the last 40 years of market structure will hold. Let me bring it all together. The oil glut was a myth. Shale declines at 35% a year. The Strait of Hormuz is closed, and the Persian Gulf cannot simply reopen, even with a ceasefire. $20 billion in LNG revenue is offline. Energy stocks sit at 50-year relative lows. The market has not priced any of this. The latest issue of the Capitalist Exploits Insider newsletter lays out the full picture, including 5 deep-value energy ideas with potential upside of 300% or more, the geopolitical incentives keeping this conflict going, and the portfolio positioning behind these calls. This is the kind of research that separates investors who saw the rotation coming from those who read about it afterward. The link to subscribe is in the description below. If you found this useful, hit subscribe on the channel too, so you do not miss what comes next. The structural shift in energy markets is not waiting for anyone.